So that's the main thing. You just have to be willing and ready to make these pivots and positions and tweaks within your portfolio as the data is coming out.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Alrighty, welcome back to another episode of Well Positioned. This is your host, Khayri Graves, and we're back with another video. We're back, baby. These are gonna keep continuing, and I appreciate all likes and comments and subscriptions to the channel. It really does help it out and gives me the motivation to continue doing this. So today, we're gonna talk about one of the methods I use to beat the market, and that's a funny thing to talk about because that is, it seems to be everyone's goal when they approach, trading or investing their own capital, managing their own money. I mean, the goal is to outperform the market, outperform the S&P 500 benchmark. And and to those who don't have an interest in doing that, and you just want to be in the market and keep up with the market and not necessarily beat it, then, being in the S&P 500 is your best way because you're still going to do well. You're going to participate in the upside, and obviously you'll participate in the downside too. But when stocks fall, you can just buy the dip and, just have the understanding that thanks to inflation, markets can and should continue higher and higher over a long term. So with that understanding, that's why I encourage all people to be involved in the market in some way, form, or fashion. But I like to present an idea that is one of the safer ways to approach the market, which is making small tweaks to some of the well-known investment vehicles that we use, diversifying in a very specific way, and allocating money in a very specific way. Picking up the book will help you kind of maneuver and guide through that. It will just be too long of a video to go over all of those things. And plus, I'd like your support with the book as well. But one of the things I'm going to highlight that is talked about in the book is how to put together a portfolio that makes sense. And now in the book, I talk about the tactical and practical ways to do so. But one thing I don't speak about in the book is, the specifics of how it relates to the economy today. And the reason I do that is because I want the book to remain a timeless piece of content. I want it to, always be relevant no matter what year or time we're in. So 10 years from now, I believe this book will still be relevant. And a few years from now, I think more and more people will be advocating for some of the things I present in the book for even average everyday investors like you and I. So today with this, we want to highlight, some of the things that I look at when I approach putting together a portfolio that is a little bit more relevant to today's market. And every year that goes by, you kind of want to do this practice or this exercise to kind of help shape how you're going to build and manage your portfolio going forward. And to me, that really starts with a macro idea, a macro understanding of where we are in the economy, getting an understanding of what is the main narrative or piece of information that is, being priced in by capital markets. Identifying that as early as possible will allow you to make the right tweaks and adjustments to your portfolio as more and more data comes down the line and comes into play. And let me explain what I mean. First thing is a macro idea that you want to generate is really going to be based off of what's going on, in the news and in the data. Those are the main two things. Now, the news is only relevant just so you can get a narrative, but the data is going to be relevant in what exactly to do and what exactly to price into your portfolio that you believe the market is trying to price in to the market. So to kind of go a little bit deeper into this, I wanted to present a visual that will kind of help us understand exactly what it is I'm talking about and trying to generate that macro idea for the year. Now, keep in mind, this macro idea for the year is always subject to change. Why? Because data constantly comes in and it may, pivot or cause you to make moves in your portfolio that are currently not priced in. So if you allow me, I'm going to kind of give my spiel on what I believe the general idea, the general macro outlook for 2024 is. I've kind of put my ideas into a portfolio, and this is going to allow me to have a mathematical understanding of what it is that I'm thinking about. And this is exactly what this pie chart shows. So this pie chart is just a general idea of things that I'm thinking about as we move forward through the year. Now you see I have three sections of ideas. And this is going to allow me to properly position my allocations into each idea so that way my portfolio is always making sense in my mind. So let's start with the biggest allocation you see here as a 50% allocation to H4L. What does H4L mean? H4L is simply higher for longer. And higher for longer is a narrative that um, a lot of market participants have been adopting when we're speaking about where interest rates are and where inflation may be, for a longer period of time than we anticipated. Because one of the narratives that took place was at the end of October, the Federal Reserve pivoted on their rate hiking cycle and said they're done raising rates and they may start to get into a rate cutting phase of monetary policy. Once that message came out from Jerome Powell, the markets generally, a lot of markets just took off to the upside after being beaten down for most of 2023. And what we saw was that there was only a few markets prior to that end of October date of last year. There was only a few stocks, a few names, and a few asset classes that was able to, still be positive throughout the year. And I'll give you one of those names, like Nvidia or even Meta was one of those names that still performed pretty well. So a lot of the big tech names and a lot of the businesses where interest rates didn't really affect their underlying business too much or didn't affect their profitability too much, those companies tended to perform well during a rate raising cycle. So the narrative that I generated, and this is my narrative that I'm adopting into my portfolio, is the higher for longer trade, where we may well be in that trade or in that or pricing in that allocation for a longer period of time. So because of that, I want to make sure a large part of my portfolio, 50% at least, and this is my own thinking, 50% at least is going to be allocated, diversified and allocated into names that would fit, would perform well in a higher for longer environment where, the Fed did say they want to cut interest rates, but if they can't cut interest rates or if they feel like the inflation is not coming down quick enough, that gives them the ability to cut rates and they stay higher with rates for longer, then what are those names? What are those stocks that will do well or did well prior to, November of last year? What are some of those names? So that kind of gives, you guys at home a hint to say, okay, maybe I want to look at some of those names that did well prior to November throughout 2023 that was able to stay strong and didn't completely collapse, when the Fed was raising interest rates. So the other part of my macro outlook in my 2024 trade, if you will, like just the overall theme is rate cut beneficiaries. So, you know, There is a possibility, and only the data will tell us, right? Like there's no way to know, what's going to do the best, throughout the year. I mean, we have some general ideas of who the leaders are, but we understand that if the data, if the Fed is telling us that they're data dependent, then we also have to be data dependent. Now, one quick caveat I will bring to this discussion is that I'm looking at all of this macro 2024 outlook and portfolio set up through the lens of a strong American economy, because that is going to allow us to be confident in allocating. The backdrop of what we are dealing with is a strong GDP. Inflation overall is coming down. It just may not be coming down as quickly as many of us would like. Um, and the labor market is very healthy. That's something I probably should have mentioned before going through all this, but definitely something that I want to mention as we keep going through. The backdrop of the US economy is strong. So moving forward, if we do start to get rate cuts, maybe sooner than we perceived, if some of the inflation data that the Fed relies on starts to come in cooler, and that may increase the probability of a rate cut or multiple rate cuts this year sooner than the market is anticipating. And if that is the case, there are going to be some names that didn't perform well in 2023 prior to the end of October bounce. After the Fed pivoted, there's going to be some names that is very reliant upon interest rates and very interest rate sensitive. And a lot of those names you can find in the smaller cap names like the Russell 2000. So if we get the market starting to price in rate cuts sooner than later, you have to ask yourself, okay, what names may benefit, from that? And keep in mind that yes, that idea doesn't trump the idea of what I have for higher for longer, mainly because these higher for longer names would also benefit from rate cuts too. So it's almost like, these names on the 50% side, on the higher for longer side, can benefit in both environments. They're going to hold up and do well in a high rate environment, and they would benefit even more in a low rate environment. All stocks, for the most part, would benefit in a low rate environment. But there's some names that would really, I think, appreciate to the upside and maybe even outperform if we do get those rate cuts sooner than later. And I want to make sure I have a position in some of those names. So this being 25% of my stock portfolio, I diversified some names, some ETFs, and some individual stocks that I think will benefit from a rate cut or from a series of rate cuts. So moving forward, let's look at the last part of our 2024 idea, and that's inflation. So we understand that, you know, inflation was coming in hot, prior to 2024, and the Fed had to take it upon themselves to raise interest rates to combat the higher inflation and try to slow down some of the demand in the economy that was causing prices to keep rising. So there was an inflationary environment that we were in and probably are still in. And, in an inflationary environment, stocks tend to do very well. But toward the end of an inflationary environment, you start to get some outperformance and some participation from the commodity sector. Um, and that's why 25% of my portfolio is going to be and is allocated to commodity style names that that can and should benefit pretty much around this current time period. And if we keep getting hotter and hotter inflation data, these names may continue to outperform because inflation is always going to find its way through every sector and every market, because if we want to, build homes, that's going to take different commodities and resources to do. If we want to continue, going to our jobs and performing and being involved in activities, that's going to take resources and energy. So a lot of the names like the oil names, the copper names, steel, even the food, agriculture, all of those things, gold, of course, is definitely something have a position in. All of those names to some extent are going to participate in the upside of markets or possibly outperform if inflation continues to stay around. So that's definitely something to keep in mind. So I hope that gives you an idea of kind of how to think about approaching these markets and that was one of the main ways, just this general understanding of where we are in the economy and what different ideas are currently on the table. Once we can identify that, then we can start to allocate our portfolio according to this. And as some of these things start to outperform, we rebalance our portfolios, and that's how we continue to buy low and sell high. And as data comes in, this macro outlook may change. If inflation gets completely crushed this year, I may be willing to move commodities or this inflation trade from my portfolio and maybe look at some deflation. Like if inflation gets completely crushed this year, well, that 25% of my portfolio from the inflation trade starts to pivot towards a deflation trade. And what does a deflation trade look like? A lot more defensive, where you have dividend, stocks that pay high dividends, bonds, or different bond, tradable bond ETFs that may start to find its way in my portfolio if the data comes out that is different than what I'm currently pricing in to the market. So that's the main thing. You just have to be willing and ready to make these pivots and positions and tweaks within your portfolio as the data is coming out. And that's why I like to follow the data, keep an eye on what's going on. And one of my favorite quotes is, if you can understand the present, you'll be able to predict the future. And I truly believe that. And that's kind of what I've seen some of the best market participants are doing to outperform or to beat the market, is they have a true foundational understanding of what's going on right now. And once you know what's going on right now, you can then predict what's going to happen 5 minutes from now, 5 hours from now, 5 days from now, 5 months from now. And that's pretty much the core of my understanding when I approach these markets. So that's one of the ways I was able to beat the market in 2023. That's one of the ways I'm outperforming the market currently. And who knows, that may change. But for now, this is something that is working very well, just having that general understanding and then allocating based on those understandings. And then we let the market tell us if we're right or wrong. But aside from that, that's all I have for you. Thanks for tuning in, and we'll be back with another one.